if I see this kind of disparity between free cash flow and operating cash flow, the money has to have gone somewhere, and it usually goes in capex. So if anyone wants to look at the cash flow statements for this company, they'll see that operating cash flow has been increasing recently, and this latest half is 25 million. But the investing cash flow is negative by 49 million.
Speaking of pulled porks, Tony, do you have one for us today?
I do. And I guess before I get into it, I'd just like to say if people didn't like that last talk about AI and boom and bust companies, send us some questions next week and some requests for pulled porks.
Shut us up. Yeah.
Yeah, because I was going down our buy list, and I think I've done a pulled pork on almost every company at some stage. So I might have to start
Right.
going back and redoing them. But I did find one today I hadn't touched before, or nor did I know much about, and it's called Findi, Findi, and it's a fintech payments and ATM provider. And I think the really interesting thing is it's based in India. So we have a company on the ASX, but its operations are based in India. And I think that's historical. I think the original founders may have been Australian. And again, this is another kind of company that's been through a few pivots over the years as well. But that's what they currently do. And they have a network of 6,000 merchants and 21,000 ATMs in India. And just to put that in perspective, they have 21,000 ATMs in India, and they're not, I guess, by any stretch of the imagination, the biggest player. But there are 26,000 ATMs in Australia. So, India is such a big place that a small company like Findi can have a meaningful market share or a meaningful presence as a business, almost the same sort of presence as the whole banking system in Australia in terms of ATMs. But they're still a small company. They employ a bit over 650 employees, and they're also applying to become a full digital payment bank in India. And I think that's interesting as well. So India has banks, retail banks like we have here. But you'd have to say, from what I've read anyway, the country is reasonably underbanked and is still largely a cash economy. So, going back to that discussion we just had, it's pretty hard if your job is riding a delivery cycle or something in the out back of one of the smaller provinces in India to go to the bank and apply for a loan and get money to build your business or to even to build a house. So it's an underbanked economy, a cash economy, but there's also been a fair bit of leapfrogging of the way banks have evolved in Australia. And a lot of banking in countries like India is done phone to phone. It's a digital environment. And so, I kind of think that Findi's tapping into this, and the fact that they're applying for a digital payments banking license, which is only a new thing in India, is quite possibly a good thing for them. The shares are up in the last 12 months, and they're up 80%. And that's largely on the basis of their rollout of ATMs and in particular FPOS merchants. And I think interesting business model. When they go out to a small merchant and do a deal to provide their FPOS terminal, they also they often go one step further and they rebrand the merchant as a Findi payment centre. Again, because people aren't used to being able to go to a particular location and top up their mobile phone or pay a bill or deposit cash or all those kinds of things. And if you go to the Findi website, you'll see what I mean. So that if you think about what might be, in Australian terms, a very small, daggy corner store, milk bar in the suburbs, that's your sort of standard shop in a lot of these towns in India. And if they sign up with Findi, they get a full sort of shop refit and rebrand and, paint and internal fit out and better counters, better to display product better. And then they get a big sign above the door saying it's the Findi Payment Centre. So that could be behind why they're picking up so many merchants. And they've actually increased their retail merchants by 90% in the last 6 months. So they seem to be doing well in this space. What else can I say about them? They don't just offer FPOS and ATMs. They offer bill payment services, credit card payments. These are all on the phone. Domestic money transfers, some overseas transfers like India and Nepal. And they're a cash drop merchant and prepaid recharges. So they're sort of filling out what would look like a digital bank. And the license will certainly help if they get that to do that. Looking at the numbers now, you can see if people have access to the bread loader, they can see it's a buy, but it's a pretty tough graph to see what's happened in the last year or so, because it's had over the last 5 years, the share price has dropped from a high of $80 down to a low of $1. So it's a huge, huge spike in the months sort of 4 and 5 of the 5-year graph. Sorry, years 4 and 5 of the 5-year graph, and it's down to almost a flat line if you look at it in those terms. But if you do have access to like a Stock Doctor graph or perhaps Yahoo Finance, you'll see that if you do it over a 3-year time period, that it's easier to see it as a buy. So that it's still gone down a little bit over the 3 years, but it's been turning up nicely in the last little while, last 6 months or so. So it's definitely a buy. ADT for this stock is 126,000, so it's reasonably small, but will suit a lot of listeners. I'm doing my numbers based to the price of 98 cents, which was the price on the weekend, but I did notice it jumped again yesterday to $1.10. So my numbers are going to be a little bit out, but perhaps not by too much. And given this is the number 3 stock on the buy list, even if I'm out by a little bit, it's not going to make a big difference to the QAV score. A couple of things to note. There's no consensus target for this company, which I think is a good thing. I've actually set up a trial portfolio on companies which have no consensus target to see if they do outperform our normal buy list. But I think it's a good thing because we're not attracting institutional money to this company. No one's of note is researching it, and therefore we have a chance to be first in. Stock Doctor do have a financial health measure for it. I'm just trying to find it now. It's solid and recovering. But the interesting thing in the Stock Doctor numbers is that they have free cash flow per share as a negative number, and we have a very good prop CAF for this company, which is positive, obviously. So something. If I see this kind of disparity between free cash flow and operating cash flow, the money has to have gone somewhere, and it usually goes in capex. So if anyone wants to look at the cash flow statements for this company, they'll see that operating cash flow has been increasing recently, and this latest half is 25 million. But the investing cash flow is negative by 49 million. And they've recently raised they now have $20 million of debt on the books, and they also did a share issue for $5 million. So this company is very much in growth mode. I didn't go into research what the capex was used for, but I'd be very surprised if it wasn't used for either buying ATMs and FPOS devices, or it was used for rebranding these stores to grow merchants. But clearly they're funding the growth of the business, partly through cash flow and partly through debt, which is not a bad thing, but I just want to call out the difference between free cash flow and operating cash flow. No dividend yield is expected in the growth stock. Stock Doctor financial health is strong and recovering. Directors hold approximately 12% of this company, so that's good. But just looking at them, I don't think they are the founders for this company. Like, again, I don't think it's a bad thing because this company has been through a number of iterations and pivots. And the directors who do own a large chunk of this company are basically investment bankers. And so this is a bit like the one we had last week, where we don't have a founder, but we have a very experienced investment banker with a large stake in the company. And I think even though it doesn't you wouldn't think it scores therefore as being an owner-founder. I think it deserves a score for having someone with vast experience and skin in the game that we can invest beside. One of those directors I'll call out is a guy called Nicholas Smedley, who's an investment banker from Australia. And it's only of note to me because he's the son of Peter Smedley, who's an ex-Shell CEO that I used to work for, who was very sharp. So if the apple fell close to the tree, then Nicholas should do well. ROE for the company 17%. PE is 10.3, which is the lowest in 3 years, but that's only really because there's only been two halves where the company has had a positive PE and been profitable. So even though we'll score it for that, it's a little bit meaningless. Prop cap for this company is 1.44 times, which is very, very low. And as I said before, they do have to take on debt to get the capex bill paid. So just be aware of that. But prop cap is price to operating cash flow is very low. IV1 for this company is 48 cents, and there's no IV2, so we're not buying it below that price, so we can't score it. Same with net equity per share. So we can't buy it for book, which is 64 cents, or book plus 30, which is 83 cents. Equity has been increasing, but not consistently over the last 3 years. So it's been increasing in the last year or two, but not for the full six halves. So we can't score it for that. But all in all, this company gets 100% quality score. So the things we can score it for gets 11 out of 11. And that's because some of these rated 2. And it gets a QAV score of 0.69, which is number 3 on our buy list. So that's a really good score. The interesting thing, I guess, is that we have a FinTech growth company on the value investing buy list. So that's an unusual thing to see, but it's happening now. And I did actually wonder if that was the case. One, because Findi obviously burnt a lot of people in dropping from an $80 share price to a $1 share price, and so is being ignored by a lot of institutional investors. But I also wondered whether, being a FinTech payment company, whether that just wasn't flavour of the month in terms of the style of investment of internet companies that people are investing now, which tend to have an AI type flavour to them. Plenty of risks in a small company like this, not the least of which is the fact that it's on the ASX, but it's operating in India. So it's not like we can go for a walk and see how the Findi stores are doing and whether they're being populated with customers or not. We can't do that easily. But I think there are real risks that there could be further capital raisings or increase in debt. I don't know at what stage they are in terms of their growth into the ATM market or the merchant market, or whether they'll need increased capital investment if they get their digital banking license. But a lot of these companies, you've just got to go into them knowing you'll probably have to put more in later. There's a risk, of course, that they don't get the banking licenses that they want or require, and that their growth could be therefore curtailed because of that. And the last risk I'll highlight is that if the company is successful, it does invite bigger banks to muscle in. So that could be good if they try to take over Findi and there's a takeover premium, or it could be bad if they just sort of muscle in and make it very, very difficult for a small company to compete. They're the risks. On the positive side of things, a lot of people are saying India is the new China. So as China gets more and more of a middle class, India is sort of, which is about, I'm going to say, a similar population size. And I know they're probably hundreds of millions of people different, but it's still a very large population. And they're still early days in terms of their expansion of the middle class, back where China was when it was starting out to do that. The need for banking services is huge, and there's a strong demand for mobile banking. So they're kind of bypassing the idea of having branches everywhere and people using laptops to do banking or across the counter to do banking. So, yeah, interesting company. Have a look, do your own research. It's a growth company. It will have growth company risks, but at the moment it's good buying.
And what happened in 2020 and like March 2021, where it's sort of the share price plummeted, as you say? Interestingly, like if I look at the Bretelator, you can see that big plummet from $80, $90 really in August 2020, down to where it is today. But if you look at Stock Doctor, even over 5 years, it's adjusted the pricing. Like if you go back to August 2021, it has the share price at $4.42, not $90. So some sort of a consolidation, it
Yeah,
suggests.
probably. Yeah,
But I'm
I'm
going
not
back
familiar
through. Well, I'm going
with the
back through
company.
their announcements in Stock Doctor around about that time. I can't see anything about a consolidation. There was return of capital, but I can't really figure out why that would cause the share price to be adjusted to that degree. They returned about $20 million of capital to shareholders. Partly as a dividend and partly as just a capital return.
Shame they did
So,
that because they borrowed $20 million in the last year or so, so they could have used it. Yeah,
well,
but I mean, this company's pivoted and pivoted and pivoted. I think it's now sort of, you could almost say it's emerging from the ashes of Findi, the way it used to be. Even on Stock Doctor, it's referred to as almost like a venture capital fund where they co-invest with entrepreneurs. And it plays down the banking side. But if you go to the Findi website, it's all about the digital banking side of things, which is its
mm,
current business. So
mm,
it's obviously had a number of iterations, and some of them probably weren't successful. And this guy, Nicholas Smedley, by all accounts is a sharp bloke, has spotted a niche and is now using Findi to fund his expansion into India.
mm. Um, Interestingly, April 2021, board has received further notices seeking to remove recently appointed independent non-executive chairman Nicholas Smedley. Board urges shareholders to vote against all resolutions at the general meeting to be held on the 19th of April 2021. Company now forced a considerable cost of convening a further general meeting of shareholders due to wasteful ongoing actions by requisitioning shareholder. So there was some sort of hostile action on them.
I'm sure.
Um,
Yeah, I'm sure
so
there's
yeah,
interesting book in the history of a company like this. Would have chopped and changed. There been lots of drama, I would have thought, over the years.
hmm.